This is Nicole, and this video is about the almighty call option, how to stay engaged in frothy markets without overcommitting. When markets rip higher and valuations look stretched, as is the case today, investors often face a dilemma. Do they sit on the sidelines and risk missing out, or buy in at elevated levels and risk getting hit hard by a correction? This is where the almighty call option shines. Why are calls so powerful? Well, they have convexity, flexibility, and asymmetric exposure. When you buy a call option, you have the potential to profit more and more as the underlying accelerates to the upside. That convex payoff is what makes them such an attractive tool in bull markets. Traders have a lot of flexibility when looking at call options. Calls are available across a wide variety of expirations and strike prices, and they provide for asymmetric exposure when you purchase them. You commit only a fraction of the capital required to buy shares outright, yet your upside participation is uncapped. So when markets really take off, a call option can deliver powerful returns on a relatively small outlay. So traders and investors who are feeling late to the party because they weren't invested earlier can have significant FOMO, or fear of missing out. In a frothy market, timing matters. Buying at elevated levels can feel like catching the last bus right before it breaks down. A call option hedges against bad entry timing and poor price location. If the rally continues, you get to participate in the upside, but if it stalls or reverses, your loss is capped at the premium paid. This lets you stay engaged without committing full capital when prices already feel stretched. So if things don't go as planned and the market stalls or goes down after you buy a call option, traders have ways to reduce losses or restructure. They can roll the call down and turn it into a debit spread in order to reduce the break-even point. Or they can sell a put or put credit spread using the credit to help finance the purchase of the call. They can also roll forward to later expirations. The point is, they're not locked into an all or nothing outcome. I want to make a point that calls are not lottery tickets. You often see this as a narrative out in the media. Critics of call options often dismiss them as nothing more than lottery tickets or gambling, especially the out-of-the-money calls. But that's a matter of perspective. With the right understanding and framework, calls can be the exact opposite of gambling. They provide defined risk up front. You know the max you can lose, and they allow for capital efficiency, freeing up cash that can be deployed elsewhere, or you can just leave the cash on the sidelines, ready to deploy in the case of a market sell-off. They also offer strategic flexibility since positions can be adjusted. And one of the most important rules to keep in mind is that if you're going to buy calls, you want to do this on stocks or ETFs that you'd actually want to own and are bullish for the long term. Using call options in this market environment can actually improve your investment psychology. When you've risked only premium instead of the full position size, you're less likely to panic during market volatility. The predefined max loss creates mental clarity because you know exactly what you're risking before you enter the trade. This emotional distance often leads to better hold-sell decisions where you're not watching every tick with the same intensity as someone who's fully committed at elevated prices. So when does it make sense to look into buying calls? Well, buying calls works best when the market feels overextended, but momentum remains strong. You want to buy calls when you have conviction about long-term direction, but you're a little bit uncertain about short-term timing. And you want exposure without full capital commitment. Implied volatility needs to be reasonable relative to expected moves in order for buying calls to make sense, and you want to do this in an underlying asset that has strong fundamentals that you believe in. So here's the bottom line. Call options are not lottery tickets when used strategically. They're tools for maintaining exposure to quality assets while managing the dual challenges of timing risk and capital efficiency. In frothy markets like we're facing today, they offer something rare, a way to stay engaged without overcommitting. The key insight remains simple. It's not about the instrument being inherently good or bad, but about using it appropriately within a disciplined investment framework. When markets feel too high to buy, but too risky to ignore, calls provide a middle path that balances opportunity with prudence. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.